Picture a world without money. No coins jingling in your pocket. No paper bills changing hands. No numbers in a bank account. How would you get what you need? This was the reality for most of human existence. Imagine a farmer with excess grain approaching a fisherman on the shores of ancient Mesopotamia around 9000 BCE. The farmer needs fish, the fisherman needs grain. But what if the fisherman doesn't want grain today? What if he needs a new fishing net instead? Our farmer must now find someone with nets who wants grain. This is the fundamental problem of barter, and solving it would change human civilization forever. The story of money begins not with coins or paper, but with trust and necessity. Long before written language, humans exchanged goods directly. Archaeological evidence from sites like Çatalhöyük in modern-day Turkey shows specialized craftspeople trading their wares as early as 7500 BCE. But as societies grew more complex, the limitations of simple barter became painfully clear. The earliest solutions emerged organically in different parts of the world. In the fertile valleys between the Tigris and Euphrates rivers around 5000 BCE, Mesopotamian farmers began using grain as a standard of value. Clay tablets from Uruk, dating to approximately 3400 BCE, record transactions using barley as a unit of account. This wasn't money as we know it, but it was the crucial first step, a commonly accepted measure of value. Meanwhile, in regions where agriculture was less dominant, different commodities emerged as proto-money. Along the coasts of the Indian Ocean, cowrie shells became prized for their uniformity and durability. In parts of Africa, salt cakes served as currency. In the Pacific Northwest, Native American groups used dentalium shells. Each culture independently recognized the need for standardized value tokens. The breakthrough came with metals. By 3000 BCE in Egypt and Mesopotamia, copper, bronze, and eventually precious metals began to circulate. These weren't yet coins, but rather measured weights of metal. A merchant in ancient Babylon might cut pieces from silver rings or bars to make payments based on weight. Evidence for this appears in the Code of Hammurabi from around 1750 BCE, which establishes silver as the standard for legal payments and fines. Economic historian Karl Polanyi observed that these early money systems developed not just for market exchange but for standardizing tribute, taxes, and religious offerings. Money allowed complex societies to function at scale. In Egypt's Old Kingdom around 2500 BCE, workers building the pyramids were paid in bread and beer, with standard rations recorded meticulously on papyrus using a unified accounting system. The invention of true coinage marked the next revolution. Around 700 BCE in Lydia, a kingdom in what is now Western Turkey, the first standardized metal coins appeared. These early coins, made from electrum, a natural alloy of gold, and silver, bore the mark of the Lydian kings, including the legendary King Croesus, whose name became synonymous with wealth. What made these different from earlier metal pieces was the official stamp, guaranteeing their weight and purity. This innovation eliminated the need to weigh metal for each transaction. Greek historian Herodotus wrote, "The Lydians were the first people we know of to use gold and silver coins and to introduce retail trade. Trust shifted from the material itself to the authority that issued it. Within a century, coinage had spread throughout the Mediterranean world. Greek city-states began minting their own coins, often depicting their patron deities or symbols. The famous Athenian owl, tetradrachms, circulated widely across ancient trade networks, becoming one of the world's first international currencies. This standardization of coinage facilitated unprecedented economic growth. Markets expanded, trade routes lengthened, and specialization increased. In Athens, during the 5th century BCE, the agora buzzed with commerce enabled by the common currency. Aristotle recognized the significance of this development, writing in his Politics, "Money was introduced as a matter of necessity, for if the needs of both parties did not coincide, exchange could not take place. But currency created new problems alongside new possibilities. Governments discovered they could alter the metal content of coins while maintaining their face value, effectively creating inflation. The Roman Emperor Nero began this practice in 64 CE, reducing the silver content in Roman denarii to finance his extravagant building projects. This debasement continued under later emperors, contributing to economic instability throughout the empire. As trade networks grew more complex, carrying large amounts of metal became impractical and dangerous. The solution emerged in 7th century China during the Tang Dynasty, where merchants began leaving their coins with trusted agents who provided paper receipts. These receipts could be exchanged for goods, creating the world's first paper money. By the Song Dynasty around 1000 CE, the government had taken control of this system, issuing official paper currency backed by metal reserves. Marco Polo, encountering this system during his travels in the late 13th century, marveled at the concept. The Great Khan has a mint in this same city of Khanbalik, where his money is coined and made. And I must tell you that the money is made of the inner bark of trees. These they cut into pieces, big and small, and then they are stamped with the seal of His Majesty. While paper money revolutionized commerce in China, Europe remained committed to metal coins until the late Middle Ages. The crucial innovation that would transform Western banking came from medieval Italy. By the 13th century, merchant families and financial centers like Florence, Venice, and Genoa had established banking houses that operated across Europe. The Medici Bank, founded in 1397, pioneered new accounting techniques that enabled complex financial operations. These Italian banks initially functioned mainly as money changers and deposit holders for merchants engaged in long-distance trade. But they soon developed a financial instrument that would transform the global economy: the bill of exchange. This allowed merchants to deposit money in one location and withdraw equivalent funds in another, eliminating the need to transport physical currency across dangerous routes. This system required meticulous record-keeping and, crucially, trust networks spanning the continent. A merchant in Amsterdam could receive payment from a trader in Naples without either party transporting coins. Instead, banks in both cities would adjust their accounts based on written instructions. This development marked the birth of banking as we understand it today.
Do you like to dig deeper? Political economy is full of powerful ideas. You're right in the thick of it. Insightful, thought-provoking, expanding every step of the way. From Adam Smith and the rise of capitalism to Marx's bold critique, mercantilism, Keynesian economics, neoliberalism, and more. Or we explore it all, clearly and from every angle. Keep the momentum going. Check the links, dive deeper, and subscribe for more.
The establishment of the Bank of Amsterdam in 1609 represents another watershed moment. It was among the first public banks, accepting deposits from merchants and maintaining accounts in a standardized currency. Because its guilder deposits were backed by precious metals in the bank's vaults, they were considered more stable than the various debased coins circulating throughout Europe. Economic historian Niall Ferguson described this innovation. For the first time, money became primarily an entry in a ledger, a virtual reality rather than a physical one. The psychological shift was profound. Value could exist independently of physical form. This conceptual leap would eventually make possible our modern financial system. The next major evolution came with the establishment of the Bank of England in 1694. Created initially to fund England's war with France, it introduced a new innovation. It issued banknotes backed not just by metal reserves, but by government debt. This crucial development linked the money supply directly to public finance, creating what economists call fiat money, currency that derives its value primarily from government decree rather than intrinsic worth. Adam Smith recognized the significance of this development in his landmark work, The Wealth of Nations, published in 1776. The gold and silver money which circulates in any country may be compared to a highway, which, while it circulates and carries to market all the corn and grass of the country, does not itself produce a single pile of either. The banker, by substituting paper for a great part of this gold and silver money, enables the country to convert a great part of its highways into pastures and cornfields, and thereby increase the annual produce of its land and labor. The Industrial Revolution accelerated these trends, creating unprecedented demand for capital and credit. New banking institutions emerged to fund factories, railroads, and other large-scale enterprises. In the United States, the National Banking Acts of 1863 and 1864 created a system of federally chartered banks that could issue standardized national banknotes, bringing order to the chaotic state of American currency. Yet the system remained volatile. Financial panics in 1873, 1893, and especially 1907 revealed the weakness of a banking system without a central authority. The solution came with the Federal Reserve Act of 1913, establishing America's central banking system. The Fed, as it came to be known, was designed to provide stability by acting as a lender of last resort and managing the money supply. Similar institutions emerged across the developed world. Central banks gained unprecedented power to influence economic conditions by controlling interest rates and the quantity of money in circulation. The economist John Maynard Keynes recognized the revolutionary nature of this shift, writing in 1930, "When the accumulation of wealth is no longer of high social importance, there will be great changes in the code of morals." The final decoupling of money from physical commodity came in the 20th century. The Great Depression had strained the international gold standard to breaking point. In 1933, President Franklin Roosevelt prohibited private gold ownership, effectively ending domestic convertibility of the dollar. The international gold standard limped along until 1971, when President Richard Nixon announced that dollars could no longer be redeemed for gold by foreign governments. For the first time in history, the entire global monetary system was based on fiat currency, backed only by government decree and public confidence. Money had completed its long evolution from physical commodity to pure abstraction. Economics professor Barry Eichengreen called this the exorbitant privilege of the dollar, as the U.S. currency remained the world's reserve despite losing its gold backing. The digital revolution brought the next transformation. Beginning in the 1960s with the introduction of magnetic strip cards and accelerating with the internet in the 1990s, money increasingly became electronic information flowing through global networks. By the early 21st century, most of the world's money existed only as digital entries in computerized ledgers. In 2008, amid a global financial crisis that shook confidence in traditional banking, an anonymous figure or group using the name Satoshi Nakamoto proposed an alternative: Bitcoin, a digital currency operating on a decentralized network with no central authority. This innovation combined ancient principles of scarcity with cutting-edge cryptography, creating what proponents call hard digital money. We've traveled from barley grains to binary code, from cowrie shells to cryptocurrencies. The story of money reveals a fundamental truth about human civilization. Our capacity for abstract thinking and social cooperation enables solutions to seemingly intractable problems. Money is not just a technical innovation, but a social technology that transforms how we relate to each other and organize our collective efforts. From the farmer and fisherman struggling with the coincidence of once to global financial markets moving trillions of dollars daily, money has evolved to meet increasingly complex human needs. Yet, its fundamental purpose remains unchanged: to facilitate cooperation and exchange between people who otherwise might find no way to collaborate. As we stand at the threshold of new monetary innovations, from central bank digital currencies to decentralized finance systems, we would do well to remember money's essential nature. Behind the complex instruments and institutions lies a simple idea that appeared independently across human cultures: the need for trusted means to measure, store, and exchange value. In this continuity, we see money not just as coins or data, but as one of humanity's most transformative and enduring social technologies.
We've got some amazing content coming your way. Subscribe now so you're first in line for fresh insights and all the good stuff you won't want to miss.